For the last 40 years, America has had a very generous, very quiet, and very reliable friend across the Pacific. That friend is Japan, and it has effectively been acting as America's banker. It's a relationship that started back in 1985, and it was simple. Japan sold the world incredible things like cars and electronics, earning mountains of US dollars. Instead of just converting all those dollars back into yen, which would have made their own currency super strong and their exports more expensive, they did something else. They used that cash to buy US Treasury bonds, which are basically IOUs from the American government. This was a fantastic deal for everyone involved, a bit like a roommate who not only pays rent on time but also lends you money whenever you need it. This arrangement was the secret sauce behind decades of economic stability for both nations. For Japan, it kept the yen's value in a sweet spot, ensuring that Toyota Camrys and Sony PlayStations remained competitively priced for American consumers. This continuous cycle of selling goods and buying bonds fueled Japan's export-driven economy, turning it into a global powerhouse. For the United States, Japan's constant demand for its debt was a massive gift. It meant the US government could borrow money at incredibly low interest rates. This cheap money allowed the government to spend more and tax less while also letting American consumers enjoy lower costs for things like home loans and car payments. It was a quiet subsidy, a financial background hum that everyone got used to. But here's the thing about a 40-year-long arrangement. Things change. People get older, debts get bigger, and political situations get messy. The quiet, comfortable financial relationship that has defined US-Japan ties is now starting to unravel, and fast. Japan is currently the largest foreign holder of US debt, sitting on a staggering $1.1 trillion worth of those government IOUs. That's a trillion with a T. But the era of Japan automatically recycling its trade profits into US bonds is coming to an end. The reasons are not coming from a place of malice, but from a place of necessity. Japan is facing its own set of enormous problems at home, and it can no longer afford to be America's primary lender. The signs are all there. The flow of money is slowing down, and the foundation of this long-standing deal is showing deep, worrying cracks. It's like finding out your reliable roommate who always covered your share of the pizza has suddenly lost their job and has a mountain of credit card debt you never knew about. The implications of this shift are huge, not just for Wall Street bankers or government officials in Washington, D.C., but for regular people. The end of this quiet subsidy means the end of an era of cheap money and the beginning of a much more uncertain and expensive future. It's a story about debt, demographics, and a desperate search for a new plan before the old one collapses entirely. So why is America's banker suddenly having money troubles? Well, to put it mildly, Japan's own financial house is not in order. The biggest and most glaring problem is its own government debt. If you think America's national debt is scary, Japan's debt makes it look like a small credit card bill. Japan's government debt has ballooned to a mind-boggling 235% of its entire economic output, or GDP. That is the highest level of debt in the developed world, by a very long shot. For years, Japan managed this by having its own citizens and its central bank buy up the debt. But now, even that is becoming difficult, and with its own interest rates starting to rise, the cost of paying for that debt is becoming a crushing burden. On top of this mountain of debt, Japan is dealing with a massive demographic shift. To put it simply, the country is getting old, fast. Japan has one of the world's oldest populations and lowest birth rates. This means there are fewer young workers paying taxes to support a rapidly growing number of retirees who are, quite reasonably, starting to spend their life savings. Those savings are the very same pools of money that were once used to subsidize American borrowing. Now, that money is needed at home for pensions and healthcare. You can't keep lending money to your neighbor when you need to pay for your own hip replacement surgery. The demographic clock is ticking, and it's ticking towards a future with less savings and more domestic spending. As if a debt crisis and a demographic time bomb weren't enough, Japan is also wrestling with political chaos. The current government, led by Prime Minister Shigeru Ishiba, is incredibly weak. Its approval rating has plummeted to a dismal 21%, following a series of fundraising scandals and economic policies that haven't worked. When a government is this unpopular and unstable, it creates uncertainty. There's a real fear that the government could collapse, which would send shockwaves through financial markets. A political crisis is the last thing you need when you're trying to manage a delicate economic balancing act. It's like trying to defuse a bomb while riding a unicycle on a tightrope during an earthquake. All these factors, crippling debt, an aging population and political instability, have combined to create a perfect storm. Japan simply doesn't have the capacity or the political will to keep playing the role of America's banker. The country's priorities are shifting inward because they have to. The government has to figure out how to pay its own bills and care for its own elderly citizens. Continuing to pour hundreds of billions of dollars into low-yield U.S. bonds is no longer a sustainable strategy. It's a painful reality check, and it marks the end of a financial arrangement that the world, and especially the U.S., had taken for granted for far too long. The money is simply running out. So, what happens if Japan, the biggest buyer of U.S. government bonds, starts selling them off or just stops buying new ones? Well, it's a bit like what happens when the most popular person at a party suddenly leaves. Everyone else starts to get nervous. The most immediate and painful consequence would be a sharp spike in U.S. interest rates. Think of it in terms of supply and demand. For years, Japan's massive appetite for U.S. bonds kept demand high, which allowed the U.S. Treasury to sell them with very low interest payouts. If the biggest customer walks away, the U.S. has to attract new buyers. To do that, it will have to offer a much sweeter deal, which means higher interest rates. These higher interest rates wouldn't just be a problem for the government, they would ripple through the entire economy and hit the wallets of ordinary Americans directly. Anyone with an adjustable rate mortgage would see their monthly payments shoot up. If you're looking to buy a new car, the interest on your auto loan would be significantly higher. Credit card debt would become even more expensive to carry. Essentially, the cost of borrowing money for anything and everything would go up. The era of cheap credit that Americans have grown accustomed to would come to a screeching halt. It would be a financial shockwave that makes everyday life more expensive for millions of households across the country. The pain wouldn't stop there. The U.S. government itself would be in a world of hurt. With a national debt already over $34 trillion, even a small increase in interest rates means the government has to spend billions more just to pay the interest on the money it has already borrowed. That money has to come from somewhere. This could mean deep and painful cuts to essential government programs that people rely on. We're talking about potential funding crises for things like Social Security, Medicare, and even the national defense budget. Lawmakers would be forced to make impossible choices between raising taxes significantly, cutting spending dramatically, or letting the national debt spiral even further out of control. This is the nightmare scenario that keeps people at the U.S. Treasury and the Federal Reserve up at night. The stability of the U.S. economy has been deeply intertwined with Japan's willingness to lend it money cheaply. The removal of that key support could trigger a bond market crisis, where investors panic and start dumping U.S. bonds, sending interest rates into the stratosphere. It's a delicate situation that requires careful management, because a sudden move by Japan could set off a chain reaction with devastating consequences. The quiet financial partnership that benefited both countries for so long now has the potential to become a major source of global economic instability. The dominoes are lined up, and the first one is starting to wobble. Faced with this ticking time bomb, a radical new idea has emerged, reportedly floated by a Japanese billionaire. The proposal is to do something completely different with Japan's $1.1 trillion in U.S. bonds. Instead of holding these passive, low-interest IOUs, what if that money was put to work? The idea is to create a massive, jointly managed U.S.-Japan sovereign wealth fund. This would involve transforming Japan's holdings of U.S. debt into active investments. It would be a monumental shift from just being a lender to becoming a co-investor and a partner. This fund would take that enormous pile of cash and invest it directly into the American economy, turning government debt into equity stakes in promising ventures. The potential benefits of such a plan are enormous. Instead of earning a tiny return on government bonds, this fund could generate huge profits for both nations by investing in high-growth sectors. Imagine a $1 trillion fund pouring money into American technology startups in Silicon Valley, rebuilding crumbling U.S. infrastructure like bridges and airports, and financing next-generation clean energy projects. Both the U.S. and Japan would share in the profits from these successful investments. The plan even includes the possibility of allowing regular American citizens to buy shares in the fund, giving them a direct stake in these national projects. It would be a new deal for the 21st century, designed to spur innovation and growth. However, while the idea is exciting, the risks are just as massive as the potential rewards. Pulling this off would be incredibly difficult. The US Treasury would have to manage the transition of $1.1 trillion out of the bond market without causing a panic and a spike in interest rates, the very thing everyone is trying to avoid. Furthermore, investing in stocks and private companies is inherently riskier than holding government bonds. The fund could be hit hard by currency fluctuations or a stock market crash, potentially losing billions of dollars. There's also the political risk. You can just imagine the headlines and political backlash in both countries about a foreign government owning stakes in key American industries. Ultimately, this proposed fund represents a fork in the road. One path is to do nothing and wait for the old system to crumble, likely leading to higher interest rates and economic pain for the US. The other path is a bold, risky, and complicated plan to build a new kind of financial partnership. It's a high-stakes gamble that could either usher in a new era of shared prosperity or end in a spectacular financial disaster. What is clear is that the old arrangement is no longer working. The world is changing, and the quiet financial relationship that defined the last 40 years must change with it. Whether this wild idea is the answer remains to be seen, but it shows just how urgently a new solution is needed.